bank of mum, dad, auntie, uncle, neighbour, school friend. That's really what it is. Yeah, I'm a bit of a dreamer and I want to help other people with their dreams. That's kind of what began this thing.
Welcome back to How to Lend Money to Strangers, or as it is today, How to Lend Money to Friends and Family, because I'm joined by Craig Smith, whose UK-based fintech, JustLend, is looking to redesign the way that we lend to the people that we know. Yeah, I mean, I know we just met very briefly after that conference in London, but your business model is one that stuck in my mind. So when I started the show, it was one I wanted to talk about. And I think it's because it's such a simple reimagining of the whole lending process where, I spent my whole career in consumer credit looking at ways to get better at scoring, to get better at identifying risk at high scale among strangers. But actually, for most people, the preferred first choice would be to go to their friends, their family, their community for money. And in the old days, it was a bit like that, where the bank was part of your community. And obviously, to get up to scale, we moved away from that and it became all about numbers and mass lending. And all the innovation's been in that space. And you've kind of looked at it and said, well, actually, we could improve, the bank of mom and dad. So a little bit, maybe if you can introduce JustLend and that idea behind it.
Yeah, it was about helping a friend get on a property ladder. Yeah, she's kind of done very well in her career now, but at that point, she needed some help. And she was like, I really want to stay in my local community and I really want to buy with my husband here. And she just asked us on WhatsApp if we lend, but it was just a lot of money to a group of people at that time. And it was like, how are we going to get paid back? Because we were all recently graduated. So although that loan didn't happen, that's kind of what inspired the idea for JustLend. I wanted to provide opportunity so people could do what they wish to do.
Perhaps maybe people could relate to that problem, but one of the first things I would think about is like, well, you're always warned not to lend money to friends or family because it can get awkward when things don't go well. And I guess that the kind of the big important part of your model then is that you take care of that in a far more clinical manner, so you're not left making an awkward phone call to your cousin.
It's GoFundMe for loans, but within your social circle, not strangers. So how it works is that you come onto our platform, you say that you need a loan for a specific subject. You then give your story of why you need the capital, the money, and then you set the interest rate, you set the terms, and then you fill in a bit of affordability information. We then do some checks on that with our own calculation. So it's for the borrower's benefit. And then if we think that you're able to afford that loan, we will then allow you to push that campaign live. We go through some more checks like ID verification, address information, sort of setting up bank accounts, etc. And then after that, you get to the campaign page where you can then share it via WhatsApp to your family members. And so those family members will then come in, see the amount of money that you are looking for, and they can pledge a percentage of it. And that's it. And once it's hit its target, which is like GoFundMe and Just Giving, the borrower can then receive, and then the repayment plan is set up, and then you will start repaying back on a monthly basis. We're kind of like a tool. So software as a service, we provide a bunch of tools to be able to help in the borrowing and lending money between families and friends. So whether that's kind of identification, whether that's contracts, whether that's payment plans, whether that's a level of reconciliation, or whether that's signposts, for example, if things go awry. So there's a bunch of mechanisms that we've created to help in the lending process, which hasn't been done before. If, the borrower gets into trouble, the borrower can communicate with those lenders to say what the issue that they're in. Say, this month I need to take a payment holiday and the reason is X. So you can push back the loan by a month or a couple of months. When it comes to repayments, they can do that as well on our platform. And there's no extra interest or any of that extra stuff put on top. We're just trying to simplify everything. And I think it's about pointing people, saying, communication's key. Like if you lose a job or, if if you got affected by COVID and you were furloughed, to inform again the family to say, look, these are things that have affected me. And if we can create communication tools to help the passing of that information, great. That's healthy.
Yeah, and I think that's quite a good positive spin on what we've been through the last 2 years, is hopefully there is a more healthy attitude to admitting to financial difficulty. COVID was so widespread in its impact that all of a sudden everybody got a little bit closer to understanding what can happen. Not everybody needed those payment holidays, but those first few months, a number of conversations people have had and seen in the newspapers and the TV, and I hope that at least all those conversations make people feel more comfortable in those sort of discussions. I've lost my job, I need 3 months. Where I'm not sure that would have been such a part of people's vocabulary. Accommodations, I need a few months to pay. I'll pay you half as much, or I won't pay you for 3 months.
Because people will just forget, and then they get themselves into maybe a terrible situation. And the lenders, on the other hand, won't have a clue to why.
Because you do want to protect the real family relationships as well as the loan.
So when it came, we were actually thinking more about the people than, well, it was all about the people rather than about profit. So it was all very much set up about the borrower sets the interest rate, the borrower sets the terms, the borrower pushes it out to people that they wish to push the campaign out to. So they push it to their family and friends. Those people that are lending can only lend to the person that sent them the campaign. And then when it comes to contracts, we provide the contract, which is written by a law firm, but then pre-populate it with the information that the borrower gives us. When it comes to the loan, the terms divided by the number of people, etc. And you can see all the repayment information on the site. We take the money from the borrower and then we disperse it amongst however many people have lent to the individual. So if it's 1 or if it's 10, we disperse that on a regular basis.
Well, you started JustLend 4 years ago with this sort of thinking in mind, and obviously the last 2 years, kind of payment holidays and flexible lending have really been pushed to the front. Have you seen any noticeable change when young people were suddenly put in a lot of financial uncertainty? What's the responses you're hearing to this flexible lending model?
So I think, one, we're only starting out as a business, although it's taken us 4 years to get to launch. We're in beta, so we're only kind of testing. And when we started, it was very much around aspirational kind of purchases. And when I mean aspirational, I mean kind of helping someone get on the property ladder, helping someone fund a gap, purchase a car to get to a job. These were the types of things that we were focused on. I think since COVID, where we've seen kind of growth in terms of people following us or signing up, and interest has been around, there's numerous things, but debt. So consolidating debt has been one. Rent. Unfortunately, some people have been furloughed or lost jobs. And if they've been furloughed, they've lost a certain amount of income. So they've had to get a temporary top up from family members. There's other circumstances there as well. So fill a gap while they get the next job. Be a carer because a relative, for example, has come down with COVID or has been hospitalized, so had to take a gap. These are some of the situations that we're seeing more and more of these types of people come to us. There was a BBC study recently that 5 million or 5.5 million people were borrowing from Bank of Mum and Dad in sort of 2019. And I think that figure is now going to grow over the next 6 months to about 9.6 million. So there's 4 extra million people that are looking for support from family members.
In my last role, we were doing household surveys during COVID, just sort of getting a feel for what people were going through. And from the start and through the whole COVID lockdown, when you say, where would you make up the gap in your budget? Friends and family is the most common item. And one of the follow-on questions from that, you've got high income families, more likely to have savings, more likely also to have this ability to fall back on friends and family. And then lower income families, less likely to have savings. And while they might have had very willing families, it was potentially unlikely that they had a single family member who could lump sum out 3 months of rent, 6 months of rent till furlough had all been sorted out. If you're not that fortunate that you can get help from your parents, you have to go to the bank. Whereas what you're saying and what you're enabling is, well, maybe your parents could help 10%, 20%. But maybe your grandparents could help 10, 20%. Maybe your friends and family could help as well. And so you no longer just need that one rich aunt who's going to kind of give you the money.
It's bank of mum, dad, auntie, uncle, neighbour, school friend. That's really what it is, rather than just looking at it as bank of mum and dad.
And I think what's also really nice is that there's obviously, with any debt, good debt is good. Taking a mortgage out is the key way most people grow wealth. But debt can be very bad as well. And there's also almost a natural sense check in how the money's been spent in this model, where you are giving a good enough reason to get people that to give you their money. It's far less likely that this is going to be debt that gets you into an ongoing debt trap. It is a model that supports sustainable debt.
One of the other interesting things about our platform is, rather than thinking purely about the borrower, you think about the lenders. And if you think about bank of mum and dad right now funding their son or daughter on a property, that's an awful lot of money that they are solely giving. And in this model, you can now kind of separate that out as well. So you can spread that risk by getting a number of family members in it. There's so much to learn about when it comes to this product as well. I feel like I spoke to you ages ago. I'm probably quite naive at the time. I don't know. I think I probably was. And we're still learning. I think that's one of the biggest things when it comes to our site. So we built a traffic light system into it. So we do the affordability, and then once we push that loan out, then we provide that traffic light to the lenders so they can see if the individual has a margin in there afterwards to be able to afford things. So we built that, and that is shared with lenders. Is that a good thing or not a good thing? Question mark. So if it's there's a bunch of features that are really interesting. Maybe we should just reject people based on what the information they give us. And I mean, we do reject people, but maybe we should just do the rejecting and not do propensity of likelihood of repayment, for example, when it comes to green, amber, red, and provide that to family members. Maybe we should, maybe we shouldn't. I don't know the right answer to that one. It's like when it comes to family members, maybe somebody's given a bunch of affordability information, like a son. The parent knows something about the child. Maybe we should be building something, a tool where the parent can then report that information about the child. But then that kind of goes into a whole bunch of social question marks around if a lender has a grudge against a borrower, what you should do in that circumstance. There's all these aspects that we will develop as we go along. In the future, we're looking at tools of, do you provide different interest rates to different people? Yes or no? Can you pay back different people when it comes to the repayments? So these are some of the other things that we're looking at and how we tackle some of these challenges as well. At the moment, you pay back everybody pro rata, but let's say if you would like to pay back one person first over another person, because mum and dad are happy to not be paid back straight away, can we build these types of things into our product as well? And these are things that we're working on too. So there's a lot going on.
One of my earlier episodes with Georg Steiger, he's got a startup in the Philippines, and one of the big loans they do is funding, so essentially seed capital to people who want to be overseas foreign workers, which is a huge way to generate a shift in income for many Filipinos. But it's expensive because you've got to get documents, you've got to get them translated, you've got to go to the capital and back and get your flights and medicals done. Then you'd go to aunties and uncles and try gather that money together. So a lot of other cultures do still, I think, have a lot of family lending, a lot of community lending that can benefit greatly just by this being much more efficient and much more streamlined. Whereas if you think of anglicized Western countries, money is not something that's spoken about all that much. So you will ask mom and dad, sure. But beyond that, we kind of get very uncomfortable. It's something that's not all that well done. And now this creates a way that actually makes it easier and makes it a very viable option.
No, it is interesting, I think. And this isn't a knocking at the door. This is a light tapping of the door as well when it comes to what we're doing, because you're not going to your parents and saying, can I have £20,000, to get a step on the ladder. It's saying, mum, dad, and many others, could I have £2,000. And that's a very different conversation. And as a friend, that is something that I'd be willing to support, benevolently lend, I guess. With WhatsApp, how WhatsApp has grown and how we now create these little groups on WhatsApp when it comes to family members about sharing pictures of our children, but not talking to our family members about, how our kids were that day. I think this is that as well. It may be easier to send a link to a family WhatsApp group to say, look, I need a couple of £1,000 and I can pay it back over this time. And for people to quickly just jump in and chip in. I think that convenience that's kind of the age that we're now at. Or the idea is you have a conversation at Boxing Day or at Christmas saying that you're looking to buy a house or maybe to buy a van to start a business or whatever it might be. And then you have that discussion and everyone around the family says, yes, I want to support you with this. But then if you've got to ring all 10 of them a couple of months later, but if you're already in a WhatsApp group, you can literally just send the link and off they go. That's it. It is interesting though, because when I started this journey a long time ago, I was working with a regulator because I originally thought that this was peer-to-peer lending, but working with the regulator discovered that it wasn't, and that's because you're borrowing and lending between those that you know, so you're not being filtered to different loans. You're just literally presented one loan, and that's the loan that your family members sent you. So I have built out a peer-to-peer platform with all the bells and whistles. So when it comes to forbearance and when it comes to collections and when it comes to ID verification or affordability, so we built our own affordability score. We put in data from Lending Club, whatever was open source that we could access to build out the best affordability models. We were trying to partner with TransUnion because we needed to put credit bureau checks in there to find out later that we didn't need those. But when it comes to working with the credit bureaus and passing information back, for example, that's something that will be there in the future too. So if the borrower and the lenders want it. So
people who would like to learn more about the platform or even raise loans on that, justlend.co, is that the best place for them?
I think, if people want to find out more information about JustLend, you can go to justlend.co and look on our blog when it comes to new content coming out. We're on Instagram as well and Twitter and social channels under @JustLend.
Thank you very much, Craig, and thank you for listening. This has been How to Lend Money to Strangers, the podcast about lending strategies around the world and across the credit lifecycle. I'll see you again next Thursday.
We actually wanted to call it Benevolend, but it had the word never in, so my team vetoed that.